Hi, this is Sarah Merard, the Mortgage Mom. Welcome back to my YouTube channel. If you have been here, welcome back. If you're new here, just to give you a heads up what to expect on this channel, I give mortgage advice, home buying tips, and I'm also a mom of a toddler. So I've got some tips and tricks for motherhood and parenthood. So make sure you like and subscribe this video and comment. I want to hear your thoughts. But today, what I wanted to talk about is discount points. So what does that mean? So in the mortgage world, you have an opportunity to see what the rate is that's available to you that doesn't cost you anything. But then your other options are to what we call buy down the rate. So what that means is that you have an opportunity to spend some money and it will go into the closing cost. So it's an upfront cost. This is not something that you can roll into your loan. It will come out at the end. But basically what it is it gives you an opportunity to buy down the rate. So how does it work? So when your loan officer is looking at the current rates and what's available to you, there's a lot of factors that go into what your mortgage rate can be. So your credit score, your loan to value, how much you're borrowing, that kind of stuff. So when they price it out, they'll give you some options, or a good loan officer should give you some options based on what the available rate is for free, but then also give you an option to buy it down. So how does that work? So let's say that, and it's a percentage of the loan amount. So we're going to use some easy math today. So we're going to use a $200,000 loan amount. So let's say you're borrowing $200,000 and you have an opportunity to buy down the rate with one discount point. So for easy math, one discount point is 1% of the loan amount. So that would equal to $2,000. So does that make sense for you? I don't know. Some people decide that they want to buy the rate down because they're going to be in the house for a very long time. And some people just don't. Some people take the risk of taking the rate that's available now and then possibly refinancing later down the road when the rates go down. So how does that work? So the loan officer will quote you basically your options on how to buy that down. And then the deciding factor for you would be your break even. So in the mortgage industry, we like to say that about 3 years is about max for breaking even on what you're going to spend. So what does that mean? So let's go back to our easy math of $2,000. Let's say it's going to cost you $2,000 and it's going to save you $100 a month. Now that's a little extreme, but we're going to use easy math today because I don't have my calculator in front of me. So napkin math it is. So let's say it costs you $2,000 and it saves you $100 a month. Your break even, basically what it's going to calculate is how long will it take you to save that $100 to add up to the $2,000 you spent, because after that point, then that's when you're really going to recoup the benefits of that $100 a month. So if you spent $2,000 and it's saving you $100 a month, that means that it will take you 20 months to break even, which is under 2 years, which I would suggest if somebody is seriously thinking about doing something like that, I would say yes, if that's something that makes sense for them. There's been a lot of question because obviously the mortgage rates have gone significantly higher than what we saw at the beginning of this year. So this has been more of a topic that's come up with my pre-approvals and customers that are going under contract. What does that make? What makes sense? For someone who wants to use discount points, discount doesn't mean what we would think a discount would be at, like 20% off Macy's is a discount. So when you're looking at your loan estimate, make sure that if you are buying the rate down, that discount point number is a number that you and your loan officer discussed. So that would be my suggestion. And to be honest with you, most people that decide to do the discount points and buy the rate down, they're going to be in the house for a long time. So they're going to recoup that benefit a lot longer than if you're only going to be in the house maybe 3 to 5 years, and it necessarily may not be the best financial decision for you. So that's why I always encourage to talk to your loan officer, go through those options, because sometimes it makes sense and sometimes it doesn't. So always take the advice of your loan officer to go through that with you. And if you have any other questions, like I said, comment below, like this video, subscribe. I want to hear your comments and questions that I can answer at any time. So thank you for tuning in, and I will see you guys next time.